Thank you everyone for coming, especially for coming on a Saturday morning. You know, it's really great to see you all out here, and I do truly appreciate it. My name's Jennifer Tozser. I'm your Senior Wealth Advisor and Portfolio Manager here at National Bank. So I wanted to get started with a recap of what happened in 2023. And when it comes to 2023, I want to say we made it through. You know what? We ended up the year, 12%, that's great, but it wasn't an easy 12, right? We had a good start and then it was terrible and terrible and terrible. And then we recovered. So thank you for sticking with me, but now it's 2024. So we're on to the next year. So let's talk about this because I think 2024 is actually going to be a lot of fun. So we're going to talk about what I call the eyes of the market and all of these other items that are on the agenda. My opening slide was about the joke about guess who's driving the bus, because despite all of the potential topics in 2024, the number one thing that I think is going to be the single most important factor is interest rates. All economies have been through this super tight interest rate regime. 10 consecutive interest rate hikes in 18 months. That's landed us at levels that we have not seen for decades. And this has caused a lot of volatility in the bond market and the equity markets. But one of the points of relief we got starting in September was central governments seem to be on pause with raising rates. And that gives us hope that they're going to turn around and start to decrease rates. And I would say they should do that. We need some reversal because I believe that they have gone way too far, especially in Canada. I don't know if anyone knows anybody who runs a small business, but it has been tough out there. So this next slide shows that once adjusted for inflation, Canada actually has the most restrictive policy of all the G7 countries out there. So if you're a small business owner or you happen to eat food and not air, you probably have noticed that your costs have escalated and profits have slimmed. So why did the Bank of Canada go so far? Well, it surely wasn't because businesses were booming and the economy was too hot. No, we actually have policy to thank for that. And that takes us to our next slide. And that would be our population growth. We are growing today at double the rate that we did when baby boomers were born. Now, considering that we are only averaging 1.4 births per woman, I so know some of you in this room are overachievers, but we're going to ignore you for now. Okay, we're hardly in a new baby boom. So what's the answer to this? It's this, it's immigration, okay? Now, I do not want to go down the rabbit hole of the ethics of immigration or the responsibility of immigration, but I will say this. When you're immigrating over 1 million people per year, and have been doing that for the last few years, pretty quickly, you've got population growth. And based upon the size of our country, that's roughly 10%. Adding to our numbers. So don't be surprised when you get a shortage of education, healthcare, and wait for it, you know it, housing. I don't hear a lot of new immigrants saying, hoo-hoo, Flin Flan, let's go there. So moving right along. So when you talk about high interest rates and housing shortages, you have to talk about the overall Canadian market. And housing is a popular asset class. You can see it, you can hold it, you use it, you touch it, you show it off to many friends. And in many markets in Canada, over the last 15 years, it's been a top performer. All right. As I like to say, the best investment ever. So this is true. This is Toronto. Over the last 25 years, if you had bought a house in Toronto, it would be worth 4.5 times what it is worth when you bought it. Okay, so take a guess what that compound rate of return is on this house at 4.5 times. Just guess. Anybody?
15.
Who said 15?
13.
13, 15, 6.22, 6.22. Okay, now why I put this in is it's the same old, is that the amount of time you're investing is what really creates the growth in your portfolio. Okay, that's the point. It's not that you need these astronomical rates of return. It's that you just need to be in the game. And yes, for a lot of people, they think, wow, 4.5 times my house. But What stock did you buy 25 years ago that you can remember what you paid for that you still own 25 years later, right? Portfolios are dynamic where houses aren't, so it's easier to remember, but it's achievable. It's achievable. This is just the point, and this is what I try and tell young people. Start investing. You will not believe where it will get you. And when you're 50 or you're 60, you're saying, oh my God, don't worry, you're going to live for another 30 to 50 years, right? There's still lots of room for investing. It's not time for cash and gold bullion, even though you might want to. So back to housing. Okay. So 2/3 of Canadians own homes. And for an average household, that represents 2/3 of their net worth. So that makes housing the single most influential asset class that is held by Canadians. Now, why am I taking so much time to talk about housing? Well, our attitude towards housing costs shape policy and specifically interest rate policy. Now, I've read that Canadians have a specific interest rate level in mind when it comes to this kind of stuff, and it's 5%. So what I'm going to anticipate is that if rates persist, mortgage rates persist above 5% for too long, we will get some type of change. There you go. So what's going to cause governments to act on interest rates? This housing affordability slide. Housing affordability does not only occur at the moment of purchase, it also happens at the moment of renewal. And this is an ugly slide. Now, if you remember last year, I was here saying, well, everybody should move to Calgary. Guess what? A lot of people moved to Calgary last year. You know, they weren't all listening to me. But at the end of the day, this is a real issue, right? It's a real issue. And you cannot afford to push Canadians out of your home, especially if you're a politician. So here are some fun facts. So in Canada, 2/3 of the population own the home and 50% of homeowners have a mortgage. Okay. So take a guess. In 1981, I know some of you had houses. This was the highest 5-year rate of interest on record for 5-year close. Anybody want to take a guess? You got 2175. 20, yeah. You play 22? I'm okay. Doris, tell me I got it wrong. She's still here today. Still has a house. Okay, and then you're going to flip to this other group here just to show you the swing. Anybody want to guess the lowest rate in 2021? Who said 144? Now it might have only been that for a week, right? But that's still it. I mean, what a difference this is. So what's happening here is that the stress that's coming in is that the last 12 months, when your 5-year rates, skyrocketing from 4.5 to 6.5, you're saying, oh, well, that's only 2% no more. But no, it's not. For these homeowners, and that's a big part of Canadians, that's 50% more that's going towards your mortgage payment. That is noticeable. That is difficult, okay? And it is burdensome. So let's look at some investment implications. All right. So this slide here, this is how banks work, and it is a massive oversimplification. But the summation is the banks collect deposits, that's your $1 million, and then they apply a multiplier and lend them out, and that's how you get to your $10 million. And it's not one for one. So let's assume in this very simplistic example, when this originally happened, interest rates to the bank were 1%. Okay, so they could lend out 10 mil on their 1 mil. Now they're 2%. So the banks have a choice. Okay, their choice is collect more deposits or lend out less money. And of course, they want to lend money at these high rates. So what are they doing? They've got to attract deposits. How do you attract deposits? What do we have today? We have some, artificially high GIC rates because the banks are buying deposits, right? They're trying to say, come and give us our money because we want to lend out money. And we have seen some of that. So back to GIC rates. Are GIC rates now a good long-term strategy? Are GIC ladders all of a sudden now a viable option? So let's go back to the 60s, all right? 4.7% looks okay. I mean, for 4 decades, GICs actually looked okay. And then, of course, we all know what happened for the next 3 decades. But you need to have a closer look at GICs. You want to look at this relationship between the prime rate and the GIC rate. Prime rate is basically a proxy for inflation. All right. So when you're buying these GICs, even through these high decades when these numbers are high, as you can see, that's why I said the house always wins. Because who sets the GIC rate? The banks do. And we all know that bank stocks tend to be a good investment in Canada. Here's part of the reason why. Okay. They're going to set the rates in their favor. Nobody surprised by that? Nope. Okay. So now we're on to our lesson in bonds. There's a quick quiz after this. Nobody's going to fall for it. Anyway, so I put this slide up last year as well, and it was just the performance of a Bank of Nova Scotia bond. How you read this is that it's a Bank of Nova Scotia bond paying a 3.1% coupon coming due in the 2nd of February 2028, and I had just assumed a $100,000 investment. So when you buy a bond, what's essentially different from a GIC is that you have an opportunity in the middle of the term to actually sell it. And because of that, it's actually reflected on your statements. So I talk about this bond. So you can see when you originally bought it, you know, it was, I said it was $99 and it's going to mature at $100,000. So it was $99,000 maturing at $100. And when we bought it in 2018, the rate was 3.22. You're looking at me today saying, Jennifer, that was dumb. But remember, rates were basically 1% then. So it was okay. It always pays its $310. That never changes. This is Bank of Nova Scotia's bond, right? There's no problems with Bank of Nova Scotia, but you can see the price going up and down in the interim. And I talked about this last year and I said, look at, you know, it's at 93, but it'll mature at 100. Well, in 2023, you know, interest rates actually still went up in 2023. So why did the bond price go up? Like, why did the value go up? It's because it got closer to maturity, right? Because it's going to go back to that $100,000. So as it gets to maturity. But in this situation, I looked at this bond and I said 3.98. We can get better rates somewhere else. So I did sell it. We no longer own this bond. So it will not be on next year's slide. But that's just an example of how you can manage bonds through a portfolio and what makes them slightly different and how you can take advantage of some of these opportunities. So the bond market was a massive disappointment in 2022, but only a mild disappointment in 2023. And I use this slide to identify, so basically opportunities and pitfalls. And what you're looking at here is you're looking at how much money you make if you own the bond. I don't know if you remember this, but about 3 years ago, I put up this slide where this bond from the Bank of England was sold out. It was actually oversubscribed, which means there were more buyers than was available, and you were guaranteed to lose money. If this is red, you're losing money. Okay? So you're guaranteed to lose money. So I look at this and you think, oh, okay. But what I wanted to illustrate here is if you just look at the US bonds, Canada didn't make this slide, we're just not big enough. But you take a look and you say, okay, if the yield on the 10-year government bond right now is, call it 5.5%, right? That's where it is at the time the slide was made. That's why there's no change in return. If they start to fall, this is how much capital appreciation you can get. So if the rate gets cut from 5% to 3%, you could make 18.1% just by holding that bond because the price will come up. Okay? Do you see what I'm saying? But look at what has to happen. I mean, we don't own Japan and Switzerland, okay? But, you know, look at how much movement you'd have to have. Rates would have to drop from 5% all the way down to 0.5 before you're even making money on your Japanese bond. We do not own global bond funds. But if you have them in your pension plans and you're saying global bond funds, what are they going to buy for you? Chances are AAA government global bond funds. Ta-da! You don't want those. So we're going to give you guys a break. We're going to talk about the election before we talk about stocks. And I said that this election, I don't think it's going to generate TV and media and excitement, but it's not going to be as exciting as what we saw in 2015 or 2020. And I think the reason is because voters are fatigued in the States. They've been listening to this for a long, long time. So I want to just take a recap here of 2020. You can see here that Biden won with 81 million votes. But what you can't see is this number. This number is 84 million. This is the number of Americans that didn't vote. Okay? So that's about 1/3 of the eligible voters. So let's talk about what makes you an eligible voter in the US. Okay, you have to be an American citizen. You have to be of age. Certain states in the US have some restrictions where if you're a felon or if you're mentally disabled, you're not allowed to vote. But we have one other requirement in Canada that they don't have in the US, and that requirement is that you actually have to have ID. So here's a slide here, and I've got the states out by colors. So the 3 groups of identification required in the US are group 1 is photo ID, group 2 is any ID, and group 3 is no ID. Now, any ID is orange. Who thinks no ID is gray? Who thinks no ID is blue? Yeah, most of you think no ID is blue, no ID is gray. California, New York, Seattle, no ID. Vote early, vote often. It's real. You can look this up. So, you wonder in Canada, because we don't think about this. We say, well, how can the Americans be so distrustful of their voting system? Hi, I'm John Smith. Hi, I'm John Smith. Hi, I'm John Smith. You can do that down there. Isn't that crazy? In today's day and age. So this just speaks to the distrust that the Americans have about their political system. All right, here's our favorite slide. I'm going to talk about some of the candidates that are out here. We're going to start with Trump. I did put out a little video to talk about some of his current woes. But the biggest thing they're trying to do right now is just keep him off the ballot. Okay, the Democrats are trying to keep him off the ballot. So let's talk about Biden really quickly. I mean, Biden's 81. In Canada, once you're 80, you have to redo your driver's test. I mean, I'm 75 in Alberta. Great. Thank you. Who said that? Thank you. Anyways, needless to say, I guess he's not too worried about it because he just drives around Air Force One, but come on. Don't they have a different candidate? So from an investment point of view, believe it or not, the person I am most worried about here is Marianne Williamson. Okay, so Marianne Williamson's a Democrat, so she says more taxes. Okay, that's predictable. But what she says is dramatically more taxes. Okay, the other thing we have to talk about is that the US has what's called a migration problem. If you don't know what migration is, it's the PC word now for illegal immigration. All right, and they've got a problem. Eric Adams, who's the mayor of New York City, has been screaming that New York City is going to be facing a deficit of $12 billion in 3 years if they don't solve this crisis, and he is a Democrat. So back to who makes me nervous here, Williamson. She's got a policy right now, in addition to dramatically more taxes, of removing Homeland Security and replacing it with a peace department. So I think that might be a little bit counterproductive to what's going on at hand. Okay. And I think that the most reasonable candidates here seem to be Robert F. Kennedy Jr. or Nikki Haley. Most reasonable. Most reasonable. This is politics. It doesn't matter what I'm going to say. 40% of you are going to disagree. And 1/3 of you aren't going to vote anyway. Actually, none of us are going to vote, but you understand what I'm saying? It's just that, I mean, the US electorate really needs to bring back some credibility in the political system. And my joke is, let's start with branding. I mean, really? Do you want to be an elephant or a donkey? Okay. So on to the stock market. I know that's what you are all here for anyway. So let's start. Are we going to make money next year? Yes, that's my plan. We're planning to make money. And I'd like to start with how we report returns. I like to use calendar returns, non-compounded. And this is why. They're easy to understand. You can recall what happened during a calendar year. You know what happened last year. And either good or bad, it's behind us. So let's just start on. So these are examples. I finally have 5-year numbers to put up. If you've been my client for the last 5 years, this is what you were looking at. Now, I wanted to put this up in this manner because I wanted you to see this -7.2. Okay, that is what happened in 2022. I know it's 2024 and I'm still stuck on it, but I hate losing money. So, but the thing is that the 5-year compound rate of return is 9.38. But if I just ever show you compound, you don't see the -7. You need to know that happens, right? And you need to know that we recover from it, right? That's what's important to me. I'm not going to hide them. Now, this next point shows the S&P 500 compared to our portfolio over the last 2 years. The reason I picked the S&P 500 is because it was up 24.2% this year, so it's getting a lot of headlines. But look at what happens. You see, if we were down 7.2, our $1 million went to 928, and then at the end of this year we were at $1,041,000. If you were in the S&P 500, even though you got 24.2 this year, you're just basically breaking even. So you've got to watch out for this. This is something I'm always trying to pay attention to, is that I'm not so fussed that the numbers are super big. I'm just more fussed that your accounts are moving forward and that when we do have negative years, we're in a position to recover, right? I'm never going to sit and say, oh, let's wait till this goes away. Nothing ever goes away in the stock market. We always have a bunch of hair on the dog and lots of issues that we have to deal with. Right? It's just how do we manage through them so we can keep making money? And that's what it looks like if you start putting them together, right? Not very exciting for 2 years, but that's okay. After 2 weak years, what do you think I'm expecting? Better years, right? So that's the same thing. So after we've had this hot year of 24.2, the next thing you're going to hear all over the place on BNN, et cetera, and CNN is, what about valuations? Are valuations too high? Well, only the S&P 500, after that big rally in December, have actually just gone back to where they were. So that's why I call this endurance training, right? We've really been sitting in a horizontal market for the last few years. So I don't think valuations are the issue. So if valuations aren't the issue, because of technical, the next thing is, well, they don't make sense because a recession is coming. This recession has been the most anticipated recession in financial markets ever. It's been coming for like 5 years, man. It's just like, it just hasn't arrived. And anybody you listen to always says it's coming in the next 6 months. Well, when you make a recession this well known, businesses are reacting, businesses are managing, businesses are anticipating. So that's why we have it. The recessions that are hurtful are the big surprises, okay? Not the ones that keep on coming. Now, what I wanted to talk about in this slide is that even though we haven't had that one big recession, I think we've actually already had them in every sector. So this is rolling recessions by sectors. They vary anywhere from -17 to -48%. And they've been lasted between 3 and 21 months, but they didn't all happen at the same time. Now, I wanted to show this rolling recession because again, it's hidden by index numbers. So if you take a look at the earliest date's August of 2021 to September of 2023, it's 25 months. Or if you just go from the high and low, it was only 9 months, all in 2022. So these stocks here, these are what we're called the FANG stocks. These were the darlings of 2020 and 2021. Here we got 2 more names. Now they're called the Magnificent Seven. We own some of these stocks, not all of these stocks for various reasons. But what the point is about these 7 stocks is that I wanted to show you this index. And this is again, the S&P 500. And we've got it shown in 3 different groups here. We've got the 15.6. This is to a different date. Okay, that's why the return is slightly different. But we got the 15.6% return if you went through that period of time. If you only held those 7 stocks, you'd have 65.3. But if you remove those 7 stocks, you only have 3.2% return. So what I'm trying to tell you is that as an index, there's a lot of stocks in there that have really not done very well, right? It's been a tough market for them. Now this, 28.2. Guess what that number is? I forgot to ask you. That's the concentration. That's how much those 7 stocks represent of the index. So when you buy the S&P 500, close to 30% of it is 7 stocks. So this is the S&P 500, going back all the way back into the 70s. And what it's looking at is what percentage of the index did technology represent? All right. Now, when I use the S&P 500 or the Dow Jones or the TSX, I'm just usually really using those as a barometer of how people feel and not as a benchmark to compare against. And this is why. I mean, look at this. Over 70%, 72% of the S&P 500 now is technology, right? If I said to any of you, hey, let's go get a portfolio. We're going to put 72% of it in technology stocks. You're going to go, bah! But we have people who say, oh, I believe in index investing. Well, did you know that's what you're getting? You're getting 72% in technology. Most people don't realize that. And I believe in a diversified portfolio. So that's why when I look at something like this, I don't benchmark to indices like the S&P 500. There are lots of companies. There are not lots of great companies. So I had a client who asked me, said, well, have I made enough money on my Microsoft? Should I sell it? And I said, no, you're not going to sell your Microsoft because it doesn't know where it's been, right? It doesn't know what its price is. We only know what they're doing, right? And going forward for the next year, I only really like to look out about 12 months. Yeah, we still want to hold it. But I'm very aware of companies that do become overvalued, especially in that Magnificent Seven. And there's a reason I don't own a few of them. So today, this is the average age of an S&P 500 company. And it's actually less than 20 years old. Did anybody find that shocking? Right? I mean, if you look back in the 1950s, you probably worked where your dad worked, right? You look at this today, chances are that company may not even exist. I talk about this again because you have to actually be managing a portfolio because things change. And this just speaks to the pace of change that we go through in the whole market. All right, so now on to today's hot topic. How do people feel about AI? Yeah, we're changing this one out. So these emotions range from ecstatic to petrified. So it is, is it cool and interesting? Is it nervously disruptive? Or is it downright scary? So here's one of the big fear items, is that my job will be eliminated. So I wanted to take a look at a previous transformational invention. And that, of course, is the car. So over the period of 1910 to 1950, the transportation industry eliminated 623,000 jobs, but it created 7.5 million. This is one of the reasons I have two boys, one's in university, one's in grade 12, and I never tell them what to do. Well, hold on a second. They're never going to watch this. But I try not to tell them where to put their career. I try to tell them to find out what they like and what they enjoy doing at work, because chances are you have no idea what their careers are going to look like and what skills are going to be required. And it's really stressful. I talk to a lot of people whose university age kids are just really stressed because their children don't have a vision of what they want to do. And I say, don't worry about it. Just finish something, figure out what you like to do, and something will present itself, because there's going to be a lot of change. So this slide here is just kind of fun. This was my dream job when I was a kid. Well, we all know how that turned out. So like I said, you don't always know what you're going to do when you're young. Now, the transition from manual labor to being a skilled worker, which is back to the cars, really created an increase in productivity, but it also created a decrease in physical activity. So no one in 1850 worried about getting their 10,000 steps in, okay? Okay, in fact, most men, in the time it would have been men, worked until their bodies gave out, right? Today, we recognize that our regular routines do not have enough fitness incorporated, and that's why 59% of adults use some type of fitness tracking device on a daily basis, all right? And I would tell you that today, we're at the same place with AI that we were at the beginning of the conversion from the horse to the car, all right? So it was really great to get into a vehicle when you were tired and it was raining and it was cold. And it's really great to drop a few sentences into Chat GPT and come up with your essay or your proposal or your email to your client. But what are you losing, right? What are you trading? Well, creativity is the obvious answer, right? Personalization. But as we rely on technology for increased productivity, it takes a lot less time to say 3 sentences than to type 1,500 words. You can be losing the skill with which you used to originally solve the problem. So I wouldn't be surprised that, going forward, just like we take time out of the day to carve for physical activities, we may start taking time out of the day to start carving for our mental activities. I did a little quiz with some of the members on my team, and it was a spell check. And I'm not going to make them do it, but I said, okay, I gave them 3 words. I said, spell these words. And they couldn't do it. And they couldn't do it because they couldn't get past the first syllable, because that's when spell check kicks in. Right? Same thing. The more you use them, they're good tools, but you've got to remember they're tools. All right. Now, the horse is out of the barn. So, I just want to talk a little bit now about ChatGPT. And I just want to give you some trivia. Okay. So this is how ChatGPT is being used by students in school. K to 12. 43% of them know how to use it. That didn't take very long, right? 8% use it for homework. 53 for essays. 48 for at-home tests. And I want you to take a guess. Take a guess at what percentage of students, K to 12, have already been caught cheating in class by their teacher with ChatGPT. It's only been around for a year. Take a guess. 55. 26. That's who's been caught. Right? Right? I went to write an exam. I was writing an exam for the CFA Institute, and I was up in Edmonton. And they used to do group exams where you had 1,000 people and you can get these individual exams. And I go into the exam and they say, okay, put your hands up, roll your sleeves up, roll your pants up, lift your shirt up. And they do this whole swabbing thing. I got a bigger security test than when I went to the airport. That's going to be the new future of students in school. Okay, roll your sleeve up, take your watch off, put your cell phone over there, look at your shoe. It's going to be pretty tough, in traditional schooling to make sure the kids aren't cheating, but they do need to learn. I said to my boys, I said, so boys, they said to me, Mom, I can't read that. I said, why can't you read it? I said, well, you did it in handwriting. I said, so you're illiterate? You better figure that out, right? But it's an issue. We'll see what happens. And when I speculate on AI, I also want to compare it a little bit to the internet. All right. So before the internet, when it first started, it was pretty credible. So you would normally, at the very beginning, you would sit down, you'd be at a dinner and you'd say, okay, who was in that movie? Who won the Super Bowl? Who did this? And you'd start to think about it. But at the beginning of the internet, surely you'd have someone who pulled out their phone and said, dot, 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 dot. They got the answer. Okay. Right now, ChatGPT is pretty reliable. It seems to be reasonable. But 20 years later, when we read information on the internet, the first thing is it real? And the reason I have this up here is I had a client inquiry about, of course, this is Elon Musk, everybody, savior of the world. This is an ad where he's talking about, how he's invented a new type of AI for investing that's guaranteed to make you rich. And it's okay because you don't need to have any knowledge really, but you just need $150 to get started. Yeah, it's not real. It's not real. But it's on YouTube and it looked real, right? So this is the next thing. And what they call that is AI generated deep fake. And what that means, it's when somebody credible is on the internet saying something that's possible, but none of it's true. So be really careful on the internet as a source for information. You want to make sure you're getting what you want to know, not what somebody else wants you to believe. And just so you don't forget, now that we're finished with AI, we're going to bring it back to Alberta. I didn't forget you. Here we are, energy. All right. So we have had high profits and high layoffs. How does that make any sense? Because oil prices stabilized. So the sector as a group has recognized that in order to compete, they need to put themselves in a situation where they can be valued based on generally accepted stock market valuations, such as price earnings multiples and dividend yields, instead of sector-specific valuations, such as recycle ratios and netbacks. Okay, so I know many of you, I'm not going to talk about this for too long because it's relatively technical, but many of you who are very familiar with oil and gas know that what a recycle ratio is if you get 1 barrel out of the oil out of the ground, you've got enough profit to reinvest and get 2 barrels out the next time. That's a 2-to-1 recycle ratio. We all know what that is, but nobody else does. But because of that style of investment, earnings, typically, you never look to see if a high quality oil and gas company even had earnings. You didn't really care what its price earnings ratio was. You cared about those other metrics. But as an industry trying to get themselves back on the platform, if you will, they're starting to care more about those things. So what you're hearing, and this is why you're seeing these layoffs, to get this SG&A, they call it, to get it down so that they can actually get earnings. So when an investment manager is looking at a company and say, oh, well, they've got a dividend yield of 5% and a price earnings ratio of 10 versus they've got a dividend yield of 5% and a price earnings ratio of 35, we're the ones with the 10. So talking about dividends, these are the oil companies we own in 2023. They all pay dividends. 4 of them increased their dividends. And Tourmaline gets a special circle because it also paid a special dividend. So why I'm mentioning the fact that they increased their dividends is that just means that the energy companies are more comfortable with their current profitability levels and what they've done to maintain. If they just think it's a one-time good year, special dividend. If they think it's something that's consistent that they can continue, they increase their dividend. So that was a really positive signal for the sector, despite the fact it wasn't a great performer last year. And finally, is traditional energy dead? No, it's not. It's still in transition. I believe that we will have fossil fuels in use for the rest of my life. Okay? I don't see any scenario where we don't have them. But the spotlight will continue to be on renewables. Just how it's going to be. So as a point of interest, once a year, right before this presentation, I don't even do it because I don't want to be affected by it or influenced by it, but I take the portfolio and I run it through a separate ESG rating company. So this is environmental and social governance, just to see where we come out. How does it look? And the answer is that we got another A, and that's been 3 years of running. And the reason I don't look at this too often is I know I can be affected by it. If I have a company I want to buy and then I peek at the ESG rating, one's an A and one's a B, I'll buy the A because I like the A. But it's not necessarily the best company. And I gave an example of that a couple of years ago where the company that I bought was a B and it way outperformed the A. And by the time 6 months came by, it was now an A. Right? So it's something I pay attention to. It's just not something that I use as the starting point of decision making. Okay? And that's why I only look at it once a year. Why this is of interest, though, there's a lot of push, and we're going to talk about this in a minute, but a lot of push from governments to pay more attention to this because it's popular, right? The governments today are popularity votes. A lot. Well, it's a general election, right? Who gets the most votes? What do they think is on investors' minds? What do investors identify with? And I tell you, investors identified a lot with ESG, except for, guess what? In 2022, what was the only sector that made money? Right? Energy. So then they went all yelled, how come we didn't have those good dividend paying stocks? Right? So anyway, auto callable notes. Back to these ones. So I've been talking about these since 2013. I always go through this slide. I always use the same example. Carrie's ready to do the presentation. No? Anyway, so this is how they work. And I like to review it once a year because these are volatility plays. These are not GICs. Okay? So this 3-year index, this is example on the left. It was based on the S&P 500 back when it was 1400 was the level. And if the index 1 year later stayed at 1400 or was greater, you got 8.25% return. If it took 2 years, you got 16.5. If you took 3 years, you got 24.75. Now, what about the downside? What if it never went up? Okay, if it never went up, this one had a barrier of protection of 20%. So as long as the index wasn't below 1120, your principal was guaranteed. But if it was worse than 1120, if it was negative 22, you get negative 22. Okay? Now, here's the history of our performance. So this was 2023. Remember, 2023 sort of went like this, right? So we only had one note that got called, but it got called in its third year for 36%. You know who you are if you got one of those. You're pretty happy. So then the second thing we had is we had 10 that went into their second year. We had 11 that went into their third, and we have a couple that are going into their fourth and fifth. And some of those ones have got rates of 15% they're compounding at. So I'm sort of on two sides of the camp. Do I want to go it for 7 years, or do I want to get it called? Because I know I'm not going to get that again, right? And since 2013, we've had a total of 126 notes that have been called with an average return of 14.35. All right. So this is the sister investment to auto callable notes called the income notes. Same idea, but how they are different is they pay even when the market's negative. So these guys pay every month. And we started adding these, and I'm actually going to have more of these next year. You'll see it when I do the asset allocation, because the rates on these have gotten pretty high. So if I can get the money every month, well, I'll take it, right? You have to really give me the juice to make me wait for it. So these guys go, and the way it works, this example, this is hypothetical. You can see the blue line, that's the underlying index. So you invest $100,000 and you see it fall to $80,000 on your statement, but the barrier of protection in this was 30%. You're still getting all your payments every month, and your principal is actually guaranteed. So it'll either end at the end of 5 years or 7 years. Believe it or not, longer is better. Or it ends if it gets above the call threshold, which is the green line. So if the indice goes above 5%, then it's finished as well. So since 2023, and thank you to Brett, because I make him do this every month, but we've got 39 open notes, 39 notes that are open with an average coupon of 8.8, and we've received 383 of all 385 possible payments. So we're starting to wrap up here. This is just a summary sheet. This just gives us an idea of what the portfolio is going to look like. I'm putting more in on the US side again. I've got more income notes than auto callable notes just because the rates are currently high. International equities and in REITs are still pretty tiny. But the other thing I want to talk about is Canadian domestic investment in mining. $3.88 billion. So I'm going to get a lot of questions about whether or not we should be investing in mining when the government's putting so much money into it. 20-year game. It's a 20-year game to get most of these mines up and running. So that's why it makes sense if they want to have mining. I'm not going to talk about if they should have mining, but if they want to have mining, it's better that they're using our money, but it's not something that's readily available for us to invest in. If mining is of interest, we're always going to be looking at public companies that are already producing. Okay? We're not going to be looking at people that are starting what's called greenfield. Greenfield means it's grass. And they got to get a permit and get rid of the grass and start the processes with et cetera, and then do the mining. We're not looking at that. We're never going to see the money. It's just going to be hype. Okay. These are the sources that we use for our research in addition to National Bank. Some of these are really expensive, some of them are not, but it's what we use to help us make good decisions for your portfolio. The lawyers really wanted to be first, but I said they can be towards the end. And that's it. Thank you.